Forget AI stocks. Forget crypto rebounds. In 2026, the real wealth isn't in chasing hype, it's in a boring system most investors overlook. And the surprising part is, this system has quietly beaten hype cycles for decades. When most people hear the word undervalued, they imagine secret gems or insider tips. The overlooked detail is that undervalued means strategies that consistently outperform the crowd. One of the clearest examples is small cap value. Research shows that smaller, cheaper companies have historically delivered stronger long-term returns, though with more volatility. Yet most investors ignore them, chasing megacaps instead. What most people miss is that boring systems often win. Would you rather gamble on hype or lean into the evidence that has worked for generations? Markets in 2026 are full of noise. Headlines push the latest tech boom, crypto rebounds, and meme stocks promising quick riches. That's classic FOMO investing, chasing hype because everyone else is piling in. We've seen this movie before: dot-com stocks in 2000, housing in 2008, crypto in 2021. The pattern is always the same. Prices surge, herd mentality takes over, and then reality hits. The overlooked detail is that the investors who win are the ones who ignore the noise and stick to boring, disciplined strategies. The foundation of this system is globally diversified, low-cost index funds. These funds own thousands of companies across the world, spreading risk and capturing growth wherever it happens. Evidence shows they outperform most active managers over time, and they do it with less stress. While everyone in 2026 is chasing the next big thing, you're quietly owning the world. That's the real undervalued strategy. And here's a question for you: do you believe boring investing beats hype chasing in 2026? Comment below and share your view. For those who want to optimize further, there's an optional lever, a small cap value tilt. By adding ETFs that focus on smaller, cheaper companies, you tap into a factor that has historically outperformed over decades. Yes, it comes with more ups and downs, but that's the trade-off for higher expected returns. The overlooked detail is that the most undervalued opportunities aren't hidden gems at all. They're entire categories of companies that most investors never touch, even though the evidence is right in front of them. Cycles always flip. The dot-com bubble proved it. Growth dominated the 2010s, but value has its turn. Hype rises, hype falls, and yet boring diversification keeps working. Even if AI crashes, even if crypto booms, even if interest rates swing wildly, this system still works. Pay yourself first, automate your investments, and let compounding do the heavy lifting. If you want the full system for saving, check my anti-budget video. The surprising part is that wealth isn't built on hype. It's built on discipline. Investor psychology studies show that the biggest drag on returns isn't fees or taxes, it's behavior. Chasing trends, panic selling, and FOMO investing cut long-term returns in half. The antidote is boring consistency. Automate your contributions. Stick to globally diversified index funds. Add a small cap value tilt if you want to optimize. Then ignore the noise. Think about it this way. Every hype cycle feels unique. Dot-com stocks in 2000. Housing in 2008. Crypto in 2021. AI in 2026. But the pattern is always the same. Herd mentality drives prices up. FOMO keeps investors piling in. Then reality hits, and the cycle flips. The investors who survive are the ones who stayed boring, diversified, and disciplined. That's the system that works. So here's the final thought. If you want hype, chase trends. If you want wealth, build systems. Subscribe for more contrarian strategies that actually work.